This video lecture will go along with Chapter 1 of your Ag Economics textbook. I do encourage you to not only watch this video, but also read the chapter so that you can be successful with your online quiz and problems for this week. Specifically, though, this lecture will help you with the Chapter 1 lecture note sheet, which you'll find also on Moodle. So this is just what it looks like. I recommend that you print this out as you're watching this video, or also have it up on your screen as you're watching this video so that you can get these questions answered and turned in. The easiest way to turn these in will be to, as I said, print it and you write the answers, and then you can take a picture of this completed lecture note sheet and upload it to the assignment tab. Or if you decide to type it, you can just type the answers, then you can just save this lecture note sheet and upload it to the assignment space in Moodle as well. I'm pretty much going to go in order with the lecture with these questions as we go here. Okay, so this chapter generally we are kind of doing a little bit of overview, defining some terms, economics and agricultural economics. Also going to define macroeconomics and microeconomics. We're going to discuss the difference between positive and normative economic policy, as well as discuss and calculate opportunity cost. So to begin, if we are defining economics, it is sort of arbitrary when we define it, but really economics is the study of the interactions between consumers and producers. So consumers are the people that purchase products, and producers are the people that create, make, or grow products. So when we study this, we study the relationships which have to do with how much is produced, how much is purchased, and what the prices are. Okay. Specifically, when we talk about agricultural economics, we are talking about only the purchasing, producing, and selling of food and fiber products. So anything that comes from plants or animals that is produced or processed, and then the consumers purchase it or the producers sell it. So we study, again, pricing, buying, selling, and profits, all in economics. We deal with scarce resources. Both consumers and producers deal with scarce resources that limit the amount that can be purchased and also limit the amount that can be produced. So there are natural and biological resources that producers, specifically farmers, utilize, which include land, soil, livestock, and crops. There are human resources, which include labor and people that contribute to make sure that a product is made. And there are manufactured resources, so machinery, equipment, things like that it takes to produce a product. So in the example of, let's say, a corn and soybean farm, a producer utilizes all of these types of resources in order to produce that crop that will eventually be sold. Because there is a limited amount of resources available, both producers and consumers need to make choices. For example, after high school, you had the choice to either go to college or to get a job. By choosing to go to college, it costs you the income that was associated with getting a job. Approximately, this would be about $25,000 a year because, likely if you got a job right out of high school, you'd potentially be making minimum wage, and that would equate to approximately $25,000 a year. That $25,000, which you chose not to do, is called your opportunity cost. So the value of what you chose not to do is your opportunity cost. So we could ask, are you okay with the fact that by you choosing to go to college, you are not making that $25,000. Are you okay with that? Well, many of you would probably be like, yes, of course, because with my college degree, I'm likely going to make more than $25,000 a year upon graduation, so it will be worth it. But the opportunity cost is the next best alternative to a set of choices that is available to decision makers. So the next slide is going to put this in the situation of a producer. So this scenario, we have the Stinsons. This is a crop farm, or they own some land. And on this land, they have three options. First option, they could grow cotton on this land. Their second option is to grow wheat, and their third option is to just lease the land, rent it to somebody else, and see what money they can make that way. So if we are calculating the opportunity cost of this scenario, we first need to figure out the profit of each of these scenarios. So let's calculate the profit for cotton. So if we grow cotton, it says we're going to yield 500 pounds per acre, and we are going to get 96 cents per pound. So if we multiply 500 times 0.96, and if I do that on my calculator quick here, one moment, 500 times 0.96, I'm going to get $480, but it's going to cost me $285 in production expenses, which could include labor, could include fuel, could include seed, could include fertilizer, etc. So I'm going to take 480 minus 285, and I will get $195. So for this first scenario, the profit is going to be $195. For the second scenario, if I were to grow wheat, I would get 50 bushels per acre. Price of wheat is $7.25. So 50 times 7.25 is $362.50. And it says production expenses are $210 per acre. So I'm going to subtract 210 off of that. So my profit there is $152.50. Okay. So my option here, growing wheat, I'm going to make less money than growing cotton. Okay. Now, if I leased it, I would receive $200 per acre, and it would cost me $40 per acre. You know, that might be maintaining fences, that might be any variety of things that a landowner has to take care of. So my profit there is going to be $160. So which would you choose? Well, you'd obviously choose the scenario where you're going to make the most amount of money, which is option 1. And the opportunity cost, by choosing option 1, by choosing to grow cotton, you are giving up the value of the second best option. So the value of the second best option is $160. So what is the opportunity cost? $160. Are you okay with giving up $160 to make $195? Yes, you are, because it's $35 more. Okay? And let's just see if our work was correct, which it was. We had all of those same numbers, so we're good there. Okay, the next concept that your textbook talks about is that of specialization. So in agriculture, many regions or companies specialize in a particular area of production. So when we specialize in a particular product, a company is likely to be able to start to produce that product way more efficiently and in turn way more cheaply. Okay. So an example of this in agriculture is that regionally we specialize in a variety of crops, and we do that for a couple of reasons. So for example, much of the wheat that is produced in the United States is produced in Kansas. So Kansas grows lots and lots and lots and lots and lots and lots of wheat. They do not grow hardly any potatoes, and they do not grow hardly any oranges. So Kansas has a surplus of wheat, but they have a shortage of potatoes and oranges. Similarly, Idaho is very well suited with their sandy soils to produce lots and lots of potatoes. So they have a surplus of potatoes, but they have a shortage of wheat and a shortage of oranges. Florida, on the other hand, has the correct temperature and the correct soil type to grow lots and lots of oranges. So they have a surplus of oranges, but they have a shortage of wheat and a shortage of potatoes. So economics also is a lot about trading, okay? So macroeconomic policies, which we'll talk about towards the end of the end of the semester, has to do with these trade and production interactions. So here we have Kansas with lots of wheat, and they are getting oranges from Florida. They're giving wheat to Florida. They're giving wheat to Idaho, and they're getting potatoes from Idaho. Okay. And then similarly, Florida is giving oranges to Idaho, and they're getting potatoes from Idaho. So specialization allows for us to produce goods in specific places in a very efficient manner and then trade with other geographical regions to provide our surplus product to them, and then to get products from them that we cannot grow ourselves. And that's not only on a national level, but that's on an international level with trade as well. And that's why trade is very, very important in the agricultural industry. So I alluded to this a little bit before, but there are two types of studies of economics. One is microeconomics and one is macroeconomics. The majority of this course is going to be microeconomics, where we really talk about individual producers and individual companies and their relationship with consumers, and also how they determine the prices of goods based off of consumer supply and demand. Okay. Towards the end of the semester, like I said, we'll touch on a couple macroeconomic policies or macroeconomic principles that really help us figure out, our nation's gross domestic product, which is the entire value of goods and services produced in our nation. We'll talk about trade, policies, unemployment, inflation, kind of big overarching principles that help us to figure out the health of the economy and evaluate that. Whereas microeconomic principles really are, how much are we going to produce? What are we going to price these products at in order to make the most amount of money? So it's really on a smaller individual scale. There's a couple videos here. I'd encourage you to click on those links to get a little bit of a better idea about the difference between micro and macroeconomics, and that's one of the questions on your note sheet as well. The next concept is fallacy of composition. So, fallacy of composition states that what is true of an individual situation is not necessarily true if it was applied to many situations. For example, if a producer who is growing wheat, we'll call him Walt Wheatman, adopts a new technology that doubles his wheat production. So he figured out some sort of trick to double his wheat production per acre. If other wheat farmers do not figure out his trick and are not able to implement the technology that he implemented, Walt's income will rise sharply. It will likely double. However, if if thousands of other wheat farmers also adopt this new technology, the supply is going to be doubled, right? Because now everybody's producing way more wheat, and when the supply is doubled, the price falls. So once everybody is able to produce that much more, there's less money to be made by adopting that new technology. So some people think, so the word fallacy is something that is not true. Some people would think that, oh yeah, if I double my wheat production, I'm gonna make double the money. But if everybody doubles their wheat production as well, everybody's not going to make double the money, because now we've got this big surplus of wheat, and the price will fall. Okay, so those are kind of the supply and demand scenarios that we will be talking about in more detail this semester. Normative versus positive economics. This is sort of confusing and honestly, it's not super important, but there are a couple quiz questions on the online quiz this week, so let's just try to get a little bit of a handle on it. Some economists study positive economics and some economists study normative economics. Positive economics asks questions like, what is the policy on, or what would happen if we change the policy to? So it is, so an example would be an economist who's working in the field of positive economics would ask, how would buying patterns of consumers change if a tax increase was placed on sugar-sweetened beverages? So they study the impact of what would happen if we charge an extra tax. They are trying to find the truth and the facts and the math. They are trying to figure out what is and what would happen if. Numbers, figures, statistics only. They are not trying to figure out how things should be or how things ought to be. They're not trying to bring any moral or ethical thought or principles into this. On the other hand, normative economics, they bring in what should be or what ought to be. So, for example, this last one is a good example. They would say, we should place a tax on sugar beverages because sugar drinks are unhealthy for people. Okay, so they try to manipulate the market based off of how they think the world should be, or what could be in the best interest of consumers or producers. A little bit more information on that on this link, so I do encourage you to look at that if you would like to. The text then talks about a couple of economic systems that exist in the world. So one is capitalism, one is socialism, and one is communism, and then there's a mixed economic system. So really, it has to do with how much is the government involved with the purchases, buying and selling, and pricing of products that are produced in the U.S. So a capitalist system is basically where there's no governmental intervention in the economy. No taxes, there are no minimum prices that people can pay for certain things. It is unregulated, basically. Socialism and communism are similar in the fact that the government has a pretty large say in how resources are allocated, and potentially heavily taxed, or just there's less freedom with the money that is made by individuals in a socialism and communist economic system. The U.S. has a mixed economic system, so we have aspects of free market where people are allowed to start their own company and to make money. However, that money is taxed, income is taxed, and then the government utilizes those taxes for different social programs. In addition, the government specifically for agriculture has minimum prices that they have set. So the USDA, United States Department of Agriculture, has minimum prices that farmers are to receive money for their products. For example, dairy milk prices can't go below a certain amount, and so that sort of helps the farmer in that sense. So we'll talk about that in one of the later chapters, but just be aware that the United States has a mixed economic system where there is some degree of free enterprise, but there is some degree of governmental intervention. The text talks about all sorts of types of economists that do analyze various parts of the economy: production, market, financial resource, and other governmental. And economists really study how programs are working. They help companies determine how they're going to price the products in order to maximize profit. And different types of economists do different things. So you can go ahead and review those more in your textbook if you would like. And really, that's actually all that I have for this lecture. I don't think that I hit on every single concept that might appear on your quiz, but I did hit on quite a bit. So I recommend that you do read the textbook to get some of the other things, and then go from there. So hopefully you're able to finish out your note sheet, and then also don't forget to complete the problem. There is a video that goes along with the problem, and reach out if you have any questions. All right, good luck this week.